Video number 20. How do I calculate the price of gold? Remember, there is no financial advice here, and I have no connection to investment funds and financial institutions. I do not invest in gold, and I have no interest in what the price will be. I'll explain techniques for calculating the price. Gold is the perfect alternative to the dollar because it is not related to the financial system, not to the Fed, not to the bond market, and it is convertible into the gold metal itself. The price of gold is based on three principles. The actual interest rate that I calculate, as I recall, is not related to the official Fed interest rate. The time for calculating the interest rate starts in 1933 until the time you calculate. As part of FDR's New Deal, the Gold Reserve Act was enacted, and the dollar rate was set at $35 per ounce, when before that it was $20.67 per ounce. Gold is a long-term investment. It is considered long-term because it does not pay interest. It contains all the interest that accumulates according to the risk-indifferent interest rate that we calculate. Therefore, in periods of uncertainty and increasing risk, its price will rise. In periods of prosperity and decreasing GDP debt and decreasing inflation, its price will fall because there is an alternative to money in investing in houses, stocks, bonds, etc. Gold is the ultimate security, and its price reflects the full risk that exists in the economy. The interest rate calculated for gold is the risk-indifferent interest rate because, as we have already said, the interest rate increases as the risk increases and decreases as the risk decreases. Before I'll show how to calculate the price of gold, I will now demonstrate what would happen if we tried to calculate it using nominal GDP or the inflation rate. The result turned out to be incorrect because they do not express risk, and as we said, gold is an accurate definition of risk and does not depend on any external factor. 1. Calculation using nominal GDP growth. The gold rate is $35 per ounce. If we compare from 1934 to 2024, the annual GDP growth is 6%, and gold was supposed to be worth $9,675 per ounce. 2. Calculation using inflation. If we compare the inflation rate from 1934 to 2024, which is about 3% per year on average, gold should be worth $614. Now the part we've all been waiting for. I'll demonstrate how to calculate the gold rate using the Fed's interest rate. Let's begin by identifying the relevant time frame. From 1933 to 2025, which is 92 years, plus one more year, brings us to a total of 93 years. From 1933 compared to the Fed's average annual interest rate of 4.67 per year, in calculating compound interest, the value of gold should have been $2,331 per ounce. To define the interest rate, we will use the standard deviation. The standard deviation for the period from 1933 to 2025 is 3.6. We will take 3.6 and divide by the root of time, which is in 93 years, as we found earlier. We will get the effective standard deviation of 0.373. Then if we add the standard deviation of 0.373 to the base interest rate, which is 4.67, we will get an interest rate of 5.04. We will divide this by 100 and add 1 and get 1.0504. Then we will raise it to the power of 93 years and multiply this by 35, which is the base price. We will get that gold should be worth $3,388 per ounce now, and this is the upper limit. If we subtract the standard deviation from the interest rate, I will get an interest rate of 4.29. We will do the same calculation process and get a price of $1,740 per ounce. This way we will get the lower limit, and that is basically how we found the range. In the next video, we will talk about how to independently calculate the interest rate for determining the price of gold, using a method based on the debt to GDP ratio and inflation, as demonstrated in video number 1. I will walk you through the full process in video number 21.